So we have started from the comprehensive. We have started this course from the techniques of stock market. That what are the types of techniques of stock market analysis, and one of them is fundamental analysis for long-term analysis, long-term investment perspective, and there is a technical analysis for identifying short-term trades. And then we learn about quantitative analysis, which is used by the high frequency trading firms or big players in the market. They initiate the trades with the help of computers and algorithmic trading. Okay, and they place the orders in a huge quantity. And what is the technical analysis? Technical analysis is a study of historical price movement on the chart, and the rule for working of a technical analysis is that history always repeats itself. And the second rule is people move the market. There are people behind the market who are placing trades and moving the market. A single person cannot move the market because he does not have that much capital requirement. Okay, over the period of time, some patterns are formed on the chart, and these patterns convey a message. And what the message can be? The message is the trading, the mindset of the people, the psychology of the people, that what other traders are thinking. That thing is, that message is conveyed by the patterns on the chart. Okay, and you can find some trading opportunities by identifying these patterns and analyzing the past performance of these patterns according to a stock behavior. Okay, what do we mean by stock behavior? Stock behavior means that a rectangle pattern can work good on Bharti Airtel, but it is not compulsorily sure that this rectangle pattern will work similarly on any other company, let's say Eicher Motors. Okay, so every stock has a different behavior in which they move. How the price is reacting, it depends on the behavior of the stock, and that behavior is decided by the people trading in the market or in the stock. Okay, because each stock has a different type of participant. Some want to buy for forecast, some want to hedge their position, some want to only take trades for a shorter term, and some want to invest for a longer term. Okay, and the next topic we have learned that what can we expect from technical analysis. We can expect some short-term trades, and the return per trade is small, but we have to remember that we have to book a consistent profit in it. And the holding period for that trade through technical analysis is starting from few seconds to it can be few months or few weeks. What, where you can apply the technical analysis? Once you have learned the technical analysis, you can apply it on any market or any asset class. There is no limitation. The technical analysis work similarly on all of the market, irrespective of the time frame. The technical analysis is similar for 1 minute time frame and for 1 month time frame. So there is no difference. Technical analysis is like thinking how to drive a car. When you learn to drive a Maruti 800, then I'm sure you can drive any other car. So there are some assumptions in technical analysis. The first is market discount everything. A technical analyst trader do not see the news or any fundamental thing for placing the trades, right? And that news or whatever the result or anything is about to come in the market. Let's say tomorrow the result of Reliance is about to be in public domain. Okay, but that results expectation has already been discounted on the chart. That what is the stock has already did his movement on the news. And in technical analysis, how is more important than why. You do not need to know the reason behind why that market moved. You just need to know how that market moved, right? And the price moves in trend. Price do not move or fly in a single direction. They move in a zigzag waves like patterns. And this rule we already know. History repeats itself. And there are some type of charts. This is the most basic formation of chart, which is a line chart. This uses only the closing price of the particular session, and that session can be anything. And the candlestick chart originated in Japan 18th century by a rice trader. Okay. And the formation of a candle uses four data point: open price, close price, high price, and low price. All right. And that's how you can form a candle, and by combining all of these candles you can form a chart. But they all are already available on the trading platform. You just have to use that information available in the public domain. And there are some type of candlestick pattern. I am not saying candlestick chart patterns, they are candlestick patterns. And in my trading style there are only two types of candlestick patterns, which is momentum candle. There are only two type of candle: momentum candle and trading candle. Momentum candle which has a body of more than 50% than its total size. Okay. And a trading candle is just a candle which have less than 50% body of its total size. And that trading candle shows us a ranging market on a lower time frame. These are all type of patterns, but it is hard to remember and very difficult to trade. So that's why we do not need to learn about this and keep remember all of these patterns. You can just use two type of candles: momentum candle and trading candle. This is a note on time frame. This is nothing but just showing that a monthly time frame has a opening price on the first day of the month, and the weekly candle has a opening price on Monday, and a daily candle will have a opening price of 9:15 of a particular session, 9:15 a.m. Okay. And this is showing you the highest price, whatever the high price in between that entire session in an entire month. For a monthly time frame it will be the high price, and similarly the low price. And at whatever the price on the last day of the month, whatever level the price is closed, that will become the closing price. Okay. But in our stock market, for closing price of a day, if let's say price has closed at 100 rupees on 3:30 p.m., that's when market close. But the closing price, this is that last traded price, but the closing price would be the average price of last 30 minutes. Okay. They will calculate the average price for the last 30 minutes for the closing price, for a end of the day daily candle closing price. That's why you will observe that the last traded price for any stock or any index is X. Then after some time that calculation happens, and the system at NSE BSE calculates this price, the last average price, and then they update this price. So the closing price would be different than this last traded price at 3:30 p.m. Okay. That's the concept. And similar, this concept is applicable to options too. The option will also have the last closing price as the last 30 minutes average price, and as a weekly candlestick pattern you will see 52 candles and 252 for daily candles in a year. Similar for the 30-minute, 15-minute and 5-minute time frame. And the most important topic in technical analysis, once you learn this, you do not need any other technical indicators or anything else to trade profitably. If you know what is a support and how to use a support and resistance with some other factors like volume analysis you can do, or you can do open interest analysis if you know about that, or you can see some previous price patterns forming at these levels, that how the price has reacted in this price zone in the past, right? You can see that and use this basic information which do not use any type of indicator and apply it for trading. That is we call a price action trading. You are seeing only a price and its structure. So what is a support? Support is a zone from where the price refuses to fall below. Okay, and if it falls below, then the support and resistance zone will change its role reversal. They do a role reversal, means the support will become a resistance for the price, and the resistance will become, after a breakout, will become a support for the price. All right, and that support and resistance is a zone rather than a exact price point. This is not a exact price point, this is just a zone. This is an illustration, we have discussed that in very detail yesterday. Okay, so you can use these price structure, price patterns, what the price is doing, because in market all of the indicators, they move behind the price, what the price is doing, then they show you some signals. Okay, but the price action is supreme, and you can use only price action to identify good trades. But you have to observe it very deeply, that how the price is reacting at this point. And what is the resistance level? Resistance level is where the price finds resistance as it rises. The price is refusing to go to the upside from this resistance zone. It is continuously moving, uh, rejecting from this level. The price is getting rejected from this level, and once if it breaks, then a breakout, and this support resistance will become a this resistance will become a support for the price. So that is what we call a flip zone. This is a flip zone, and this flip zone gives us some trading opportunities. Okay, so the longer these support and resistance takes to form, and the maximum touches it has, the more significant it will become. Okay, this has a very great significance because this has maximum touches, maximum rejection from this point. They have 5 previous rejection. So you can observe that if the price is breaking out, you can enter above, or if the price is again rejecting from this zone, you can initiate a short sell at this point or anything further. Okay, and these type of rejections, or you can say fake breakout, can happen and they will occur. You cannot minimize this thing. How you can minimize this thing is by combining as much as signal you can add up to this trade. If the volume is also good at this point, and subsequently again the volume has not started to diminish, and the volume is increasing till this candle, okay, then you can see that this might be some good, or you can use that the previous trend line support and resistance zones, or you can use any channel line. You can use open interest at this point, that what the participants in the markets are doing, what new participants are doing, right? So you can minimize by that, but they will occur. So that's why you have to use a stop loss, because you cannot be always right. If you are wrong in any trade, then you have to know that at which point you should have to exit from that losing position. If you don't know that where you will exit your losing position, then it might be end of your trading journey, because the capital protection is very supreme in trading. You have to be in the game to win the game, or you have to play regularly, or whatever your time period is, you have to be in the game to win the game, right? And we already know about what a rule of reversal, change in polarity. This is a flip zone, as we have discussed. A resistance zone, the maximum touches it has, the more significant it is, and the longer it takes to build, the more significant it is. And if a support is identified on a 5-minute time frame, okay, and a support is identified on 1 hour time frame, so which support or resistance has much significance? Of course, the 1 hour time frame support has more significance, because it is on a higher time frame and it would have take a longer time to build. Okay, and these 5-minute time frame support and resistance are likely to broken down or broken out. So that's why these 1 hour or 1 day support and resistance are very significant than 5-minute support and resistance. You can buy the breakout of resistance point, okay, and put a stop loss below some support zone, or below the any significant swing lows. You can put a stop loss here if you have traded at here, or if you want to be aggressive, you can place your stop loss at this point. Selling the support breakdown, you can short sell any stock or any index when the support is breaking. Okay, you can put your sell order a little below the support zone, because many of the time these type of candles can occur. This green candle has a low below the support zone, and this also have a low below the support zone. So this type of extreme movement can occur when the price is moving in a direction. So it is better to place your stop loss and entry price above and below some points. No, do not place the trades at the exact point. If someone told you that 400 is a strong resistance for a support for a stock 400, then just you should not place a buy order at exact 400 point, because the price can move up to 402 rupees and then it can move down. So it is always better to use a stop loss order or a target order, sorry, a limit order above some points of that resistance zone. You can play in between the support and resistance, you can sell the resistance and you can buy from the support. Okay, and we have discussed about trend analysis. What a trend is? A trend is an overall direction of market. The trend is identified by trend line, or you can identify it by moving average too, and it will be, the trend line will be drawn by connecting higher lows to identify an uptrend, and for a downtrend you have to connect lower highs. And there will be only three type of trends: the uptrend, the sideways trend, and the downtrend. So the rule is that market cannot stay in a range for too long, and the market cannot stay in a trend for too long. If a market is in range, it will eventually break out and become a trend any side. We do not know that which side it will break out, but after a successful breakout, it will become a trend. But uh, and when this trend has initiated, it will initiate new range for the market. It will become again in range, then it will reverse or it will go down. It We will know that on the breakout only. So the logic for identifying a trend is that you have to identify the current market trend as soon as possible and sit in that trend and ride that trend, right? So if you have identified this trend that this crossing of this point will initiate a new uptrend, so you can enter at this point and you can wait for the trend to unfold, right? So the thing in trading is trend trading is you have to identify the trend direction as soon as possible and sit in that trend and ride that trend unless and until it will change its direction, right? It can become a sideways trend or it will become a downtrend, but it will give you some signal before changing, because when a oil tanker is moving in a one direction, right? When a oil tanker is moving in a one direction, so the oil tanker is going forward, so the driver wants to drive it reverse, so the truck has to stop a little, has to slow down a little, then it will change the gears from forward to reverse and then it will start, and then the reverse gear will pick up the momentum and then price will move up. So that's why how the oil tanker takes a time to go into a reverse mode, right? That's how the trend also takes time to change its direction. All right. This is just a theory. You can read that higher highs and higher lows. And you can identify the trend by trend lines. This is theory for downtrend. The sideways market is nothing but a ranging market. Whenever the market is in range, it is in sideways. So today we will be studying about starting a new topic about technical indicators. What a technical indicators is. So the technical indicator means these are some tools available to a trader. Are we going good?
Yeah, Sanjay.
Okay.
Excellent.
So the technical indicators are tools available to a trader that signals some market movements, right? Uh, these technical indicators derive their value from the price by using some mathematical formula. Okay. If we say that moving average, although moving average is an indicator, but I do not include moving average in a indicator uh, category, because moving average is just like a basic requirement of naked chart. Okay, moving average work very good. You will see that. Technical indicators are tools used by a trader for analyzing market movement. Okay, these indicators tells you different factors. Let's say an ADX indicator will tell you the strength in the market, and the MACD will tell you the momentum of the market, right? And the moving average will tell you the position of the current market, that the market is overpriced or underpriced according to the average price. So technical indicators are historical pattern based signal produced by using price. The first thing is price, then they can analyze volumes, and they can analyze open interest too, and they can use the total traded quantity, the volume. Okay, so by analyzing historical data, technical analysts use indicators to predict the future price movements. All right, uh, you can do all of this. What a technical indicator is telling you, you can do it by manually. Okay, you can calculate everything by yourself, but these indicators are programs, and all of the conditions which you have to do it physically by yourself. They unload some work for you, and they have created some indicators by which you can use to predict some factors affecting the market condition. Okay, there are some categories of technical indicators. There are some indicator which moves behind the price. Okay, this signal after the price has moved. And there are some indicators which we call them leading indicators. Leading indicators means they provide a little ahead signal, a little ahead of price. And those indicators which lag behind, they are called lagging indicators. Okay, so the leading indicators is give trade when a trade is about to start. Okay, give trade signals when a trend is about to start or any condition is about to fulfill, where the what the market is about to do, it will tell you a little ahead of the price. They try to predict the future price, sorry, by using shorter period in their calculation. They are leading indicators. You can see, you will see some stochastic, RSI, relative strength index, which show you the strength in the market. And there are some lagging indicators which follow the price action. And the lagging indicators is moving average. The most common indicator is moving average in lagging category. Okay, they lag behind the price. So because why the moving average is lagging, because it is calculating the average price for the last whatever the period is we have selected. If we selected 10 days, then the moving average will be the average price of last 10 candles. Okay, so that's why this is a lagging indicator. It is calculating the price after it has already been done. So the first type of technical indicator is moving averages. What a moving average is, we know about average. Okay, we know about what an average is. Average is like I let me see on the example. So moving average is a technical indicator that averages an asset's price over a period of time. Like I said, whatever the period of time can be, you can use 10 days, 50 days, 100 days, or the input is customizable. This is the greatest feature of moving average, that you can customize it in a matter of seconds. Why we know about why it is called an average, but how that moving average is moving in nature, why it is called moving, how it is moving. So if we are calculating the price of last 5 periods, okay, this is last 5 period, and the price can be 10, 12, 13, 11, and 9. this is the price movement. You can total this price. The total is 55, and to know the average of this price you have to divide it by 5. It will be, the average price would be 11. But how this is in moving? Okay, so let's assume that on the sixth period, a new day started. On the sixth period the price has closed around 12 rupees. Okay, so this is the new data point which have been added. Now this 11 is the this 11 average price is for only these last 5, but now a new day has been added. So what this moving average calculation will do is it will remove this first day data point from this series, and it will add this new data point. So whenever a new data point is introduced, it will remove the first, it will remove the first value, and it will add the recent value in the calculation of moving average. So now we have to add, for new moving average we have to add 12 plus 13 plus 11 plus 9 plus the new point is 12. It will be divided by 5. Then the new average price would become 11.4. Okay, that's why we call this is a moving average. That's how the moving average works. Okay, so the technical indicator is described as moving because the introduction of new figures will replace old data points. जैसे ही नए पॉइंट्स ऐड हो जाते हैं, ये अपना लास्ट जो फर्स्ट ऐड हुआ था उसको रिप्लेस कर देता है न्यू डेटा पॉइंट्स. ओके, and move in a line on the chart. It moves like a line on the chart. If let's say this is a candlestick formation, candlestick chart, this type of candles are forming on the chart, so these moving average will display you like a line on the chart. All right, moving average can be used to identify support and resistance. I'll show it on a chart example. Moving average is a trend following indicator. Moving average do not work well when the market is in range. When the market is in a horizontal range or moving in a very narrow band, then the moving average do not work well and they will give you very false signal. So the first and foremost property of moving average is they only works well when the market is trending, when the market is in a very good trend. The trend can be uptrend or downtrend, it doesn't matter, but the price needs to be moving in a trend to work with moving average. And historical price data is needed to plot moving average on the chart. You can plot a moving average for 500 last 500 period. Okay, but you just need the data point, means the price for the last 500 period. The period can be a day period, a hourly chart, a 5-minute chart, whatever it can be. If you are using a 50-day period on a daily time frame, 50-day period moving average on a daily time frame, then it would be calculating the average price for the last 50 days. But if you switch to 15-minute time frame, let's say, then it would be calculating the average price for the last 50 candles on this chart. Okay, it will not, no longer it will be calculating the price for last 50 days. It will be calculating the last 50 candles price, and you can modify. Okay, so this is just an example of average. that how average can be identified, that some five people are sitting on a beach and they were drinking whatever they can be drinking. They are drinking, let's say, cold drinks. Okay, and they left the empty bottles on the beach, and a person saw that five peoples are leaving, and at a further few steps ahead he saw that total 29 bottles are there, right? 29 bottles are there, and he saw that five peoples are left i- from here. So he want to know that how much bottle a single person has drink. Okay, what means a single person cannot consume 29 bottle. So he wants to know that how much bottle is consumed per head. So he will divide 29 total number of bottles with 5 because of the 5 person, and he will came up with a result that each head approx 6 bottles are consumed per head. So that is how you can determine the average price. This is how the moving average chart looks like, right? And you can see that moving average is this line, and this is the chart formation. So what we are seeing is, if we start from this point, we are seeing that when the market is in range, like you can see, this is the range. The market is in very narrow range in this point. These are some whipsaws, but after that whipsaws, the market has again turned into a good range. So the moving average will become flat or will become curly. A zigzag movement for the moving average will become if the market is in range. So that's why moving average do not give better signal to trade in between the ranges, but it gives you a good signal. How it is giving a good signal? When the market is trending, so you can see that the market has started to moving upside from this point, and it moves very much high, then it retraced a little bit. It moves in opposite direction of its prior trend. So prior trend was upside, the major trend is up, and this price has fallen up to only moving average line, and then it again reversed. So this is your trading opportunity. You can place a buy order at this point to trade the second leg. As I mentioned, the a single direction of a market movement will calculate as a leg. We will call it as a leg. And after one leg, a retracement is expected. And then if the price started to continue move upside again, then it will become a leg 2 in a trend, and most likely the trend moves in two leg direction. Okay, rarely three leg and four legs happens, but most of the cases, 80% or 70% of the times, the market moves in two legs only. The trend moves in two legs. Whenever we are seeing a downtrend, then the downtrend will also move in two legs. Okay, so this is the single direction of downtrend. Then we have seen an opposite movement, or a pullback. Then we are, if the market trend is starting right to the downside again, then this will become leg 2 in a downtrend, leg 1 in a uptrend. So this is very important to know that in which leg you are trading. So we assume that after a range, the market has started a new trend, and it gives a retracement up to the moving average point. And you can see the moving average is acting as a support zone. That is how you can identify a support and resistance point by using moving average only. Okay, so you can see here this has become a major support for the price because this range has been formed at this point, and you can place a trade when the market has showing you a signal that price is taking support at this moving average point. Then you can place a trade in the long direction and you can easily achieve this much target. And as the first leg and second leg is done by the market has been gone into a range again. Okay, and in range the price is falling to the downside. It is giving you a short sell trade, then it again hit your stop loss. So in ranging market, the in ranging market it do not work well, but in trending market it works very well. Okay, this is how you can trade by using moving average. These are two trading opportunities in it. The price is taking continuously taking a support. You can just accumulate some of your position in this range, or you can buy the breakout of this range, or you can buy the breakout of this prior to resistance. These two times the price has got rejected from this points, so this has become a horizontal range for the, and for the third time when the market has started to moving upside, you can place a buy order some points above this resistance. You can enter at this point, you can enter at this point, or if you have missed this entry, you can enter at this point. Okay, moving average do not work good in sideways market. You can see the market is in a range. The market has not gone anywhere. These are some whipsaws movement. These are extreme movement which are not sustainable. Okay, so we are assuming that this is a range, and you can see the price has crossed to the upside. The candle also closed to the upside of the moving average, but it does not sustain there and again fall. Then again it took a resistance of this price, as this is, you can see the moving average can be used to identify support and resistance zone. So that is how you can identify a resistance point by using this moving average. Okay, but the thing is, like the moving average is customizable. So when we say that 50-day moving average, 50 period moving average is working well, so it is not guaranteed that this 50 period moving average will show you a very good signal on all of these stocks. If this 50 period moving average is working well on uh, uh, MRF tires, okay, it might not be working well on some other pharma stock or IT stock. So each stock or each index has their different behavior, and they require some modification in using the technical analysis. You today you will learn about the moving averages, but you have to identify it by yourself by using trial and error method, that on which stock which moving average is working well, which moving average is giving you good trading opportunities. Okay, we will discuss it on much more later. And the exponential moving average, what do you mean by exponential moving averages? This is just a variation of moving average. Previously what we have discussed it a simple moving average, but there is a variation to it. This variation is called exponential moving average, which gives a higher weightage to the recent price movement. Okay, how it can give you the recent more weightage to the recent price movement is, let's say we are calculating the average price for 5 period, then this is the most recent, so it will give its weightage to the price, whatever the price can be. but when it is calculating, it will multiply it. It will be giving more weightage to the recent prices. So it shows us that more significant the recent price movement is instead of the previous price movement. So they are very much similar. They do not have any difference. But the exponential moving average will react to the price more frequently and more speedily comparison to the simple moving average. Okay, it reacts fast. So this is a 50 period moving average, exponential moving average on Ambuja cement stock, and that's how you can see that the market is in uptrend. It has given you a buying opportunity at this point, and it has shown you a support and resistance zone too. Okay, the price took support at this point, the price took support again at this point, again at this point, you can see. And when the price in downtrend, it is taking a resistance of this moving average. Okay, and what the other method of buying, the first method we have seen is you can buy when the trend is about to start its second leg up in the trend. Okay, we will wait for a pullback to see that if the price is taking support at the moving average, and then we will initiate a new buying position in for the monetization of second leg in a trend. But there is a second method too. By using this, you can buy or sell your quantities. So what will be it is when the price crosses above the moving average, it signals a buy. Okay, when the price moves above the moving average, it signals a buy, and if it crosses below the moving average and successfully closed a candle below the moving average, then your short sell signal is triggered, or your closing of old position. If you have bought at this point, you will close this position at this point, and you have this much profit for your this trade. Okay, but as this single price crossover or cross down, with this price has crossing down to the downside, right? So you can short sell at this point and you will have that much of profit. But these type of bad signals can be generated, right? The price has moved to upside, candle closed successfully, but it hit your stop loss. Okay, so these type of fake signal can occur. So what you can do is you can use two moving average. We will see that combination of moving average. You can use two moving average to get a trading signal. All right, so this is a sideways market in which a 50-day moving average and 200-day moving average is applied on the chart. The blue color line is 50-day moving average, and the 200-day moving average is red color line. Okay, so we are buying when the crossover happens. So this is the first crossover when the blue color line crosses from below to above the bigger moving average. This 200-day is bigger moving average, and it is also a slow moving average. It moves slowly, it reacts to the price slowly than the small period moving average. This is a small period moving average, or it can be said as a fast moving average, because the 50-day moving average reacts very frequently to the prices, very fastly to the prices. Eh, right? So the red one is slow EMA and the blue one is fast EMA. So what you can do is you can use the crossover. You can use the crossover to buy and sell by using this moving average. You can imply the first condition for your trading crossover of fast moving average above the slow moving average for buy entries, and crossing below the fast moving average below the slow moving average. If the 50-day moving average crosses below 200 moving average, then it will signal a short sell. Okay, and at this time it has signaled the short sell. You can short sell at this point, and that is why these crossovers are a little late, because the price action has already been done. They move behind the prices. They move behind in prices. So the first condition is cross over or cross down of the moving average, and you can add one more condition to make the trade strong, that the price, whatever the price is, the price should be above both of the moving averages. Price should be greater than both of the moving average price. Okay, and you can add third condition in it too, for adding more confirmation, that the volume should be greater than the average volume. You have add three conditions in this basic moving average crossover strategy. All right, I'll show you the data of how I have made a crossover strategy in TradingView, and I have backtested that strategy, that it is working on this stock or not working. Okay, so till now we have learned about moving average crossover system. So the crossover system is a modification of single moving average system. Single moving average is this is the moving average, and whenever the price is crossing above the moving average, you will initiate a buy trade here. Okay, and if the price crosses below, then you will initiate a short sell by using this single moving average only. But this single moving average can generate far too many trading signals in a sideways market. So you should know that, identify that sideways market is not there, the market is trending, and you can use two moving average instead of a single moving average. Okay, two moving average you can combine. We have seen an example of 50-day moving average and 200-day moving average. The first moving average will be a fast moving average, 50-day moving average. It is called small moving average. You should not get confused in knowing that what a small moving average can be or a fast moving average can be. It is all the same. Small moving average means it is using a smaller number of periods than this moving average, than this 200-day moving average. Okay, so that's why this is called slow moving average, because it reacts to the price very slowly than in comparison to 50-day moving average. Okay, so you have any doubt till now, you can unmute and ask.
Sanjay, which moving average is, based on your experience, which is a best period for a 15-minute or a 5-minute graph on Nifty and Bank Nifty? I mean, based on your experience.
Actually, I did not get that moving average has worked very well on bank nifty for option buying or things like that, because if you see on the charts for a moving average, if because the price movement in option and option premiums, okay, they do not make a feasible style trading style for using a moving average as a for trading in bank nifty and nifty. You need to master 2 minute time frame and the moving average on it. 9 day period and 21-day period, you can use those two moving averages, and then you can use it on 2 minute time frame for bank nifty or nifty, because the movement in nifty and bank nifty are huge in points. So they signal a little late, and till then you will be not able to hold up to that losses. uh, this is a 1 hour time frame, and we have applied 21-day period moving average and 51-day moving average. So it is a better system to take trades on a short sell side in nifty and bank nifty. You can take trades by using this 21 and 51-day moving average. Okay, if the crossover has done at this point, you can sell the puts. You can sell the puts positionally for a period of a week or 2 weeks, like that. If you sold puts by using this crossover, then you will be getting all of the premiums of that put in your pocket, right? And this again a crossover signal has been generated, and then you can initiate a short sell of call position for a positional trade, and then you can see that handsome profit has been done, right? So you can use moving average on a positional basis. Otherwise, you have to use it on 2 minute time frame, and 2 minute, 3 minute time frame give too much whipsaws movements. And most of the time, the bank nifty and nifty will be trading in a range only. So when the nifty and bank nifty is in range, you have to be a little bit careful in trading this. Okay, I did not able to grasp the moving average in the construct of uh, nifty and bank nifty. If you can also use that and try to came up with some good combination, that which it is working or not working, you have to do a visual inspection, visual backtesting, that it is working or not working, how these signals are generating in this system. Or you can just put up your codes, the moving average codes in the Pine editor, and you can easily see that the strategy is only 21% profitable, and the max drawdown can be 29% in it. So you can use this type of systems to backtest your strategies by using this system. See, this is this long and short. These all are trades generated by this signal. Okay, whenever a crossover is happening, a system is generating a short signal or a long signal. So you can see there are some bad signals has been generated by using this system on a 5 minute time frame, right? And you can see the net profitability and max drawdown on each and every time frame. So on 15 minute time frame, this strategy is working fine. So the max drawdown is only 16% of your capital, and the net profit is a 95 percentage, and 84 trades has been placed in this by this strategy, and it is only 35.71% profitable. Out of 100 trades, 35 trades will only get you in the profit. Otherwise, other 65 trade will be losers. But after 65 losers too, this strategy is able to give you profits. Right? You can check it on a 30-minute time frame too, that the profitability has increased, max drawdown has also increased, and the profit percentage has been decreased. So you can change these inputs, that if you want to use 29-day moving average as a fast EMA, you can click on it and see the implication that it is working or not working. Okay, you can do that on a technical way, or you have to do it manually. Any other doubt? Shall we move ahead? Hello.
Yeah, absolutely.
Okay.
Yeah, yeah.
Okay.
Go ahead.
The speed is fine too, right? We are not going too
Yeah,
fast. Okay, so some rules for buying and selling of a crossover system, which is similar to what I have described to you, that you can use uh, crossover of a fast moving average above the slow moving average. Okay, for the shorter period means the whenever the 50-day period moving average crosses above the 200-day moving average, you can buy new long positions. And if if that 50-day moving average, after you have bought, if that moving average tries to cross below, if it tries to cross below, then it will be giving you a signal to close your previous position. Okay, so this is 50-day moving, 50 period EMA and 200-day moving average. You can see the signals generated by this system. I think this is Bajaj Finserv or so chart. So these 50 and 200 combination is working well on this chart. Okay, this crossover has signaled the first short sell signal. Then this crossover is signaling you to close your previous short sell position, and initiating a new long position from this point. So this is the property of moving average, is that it always keeps you in the trade. Okay, once you have shorted, it will, when it signals you to exit that short position, at the same time it is signaling you to initiate a new buy position. So that is signaling you, that will always keep you in the trade. Your money will be always be employed uh, by using this method. Okay, so when you have initiated a new long position at this point, and this signal has again generated for closing your previous open position and initiating a new short position, right? So it will depend on stock to stock. and this is again generating a buying signal after a range. The range you can identify here. This is the range, and as much as signal you can identify, you should add it to your system, that you can see this low and this low is similar, so they have created a double bottom pattern. Sorry, so they have created a double pattern. So what the bottom pattern signifies is, when the neckline is broken of a double bottom pattern. We will see in detail how the neckline works and what is the neckline, but for just know about a general idea, you can see a crossover has been, so simultaneously a double bottom pattern has been formed and a crossover also has been signaling a buy, and the neckline for this double bottom has also been broken. So we have combined three trading signals and initiated a buy position at this point. You can use a stop loss below the double bottom pattern, or you can, if you are aggressive, you can use a smaller moving a smaller stop loss just below your entry price. Okay. This is 20-day, 20 period and 50 period EMA. Okay, so this is also working fine according to this system on this stock. As you can see, it has signaled a buy entry at this point. It is signaling you a start of a new trend. Okay, and of course a new trend has started and it will give you too much profit. So what is your exit condition? Your exit condition will be same, that you will exit on again a cross down when the fast blue color moving average go below the red color moving average, then only you will exit your position. So you can able to capture this much movement, this much price movement in single trade, and then a short sell signal has been generated. Then in the short sell, after again a crossover, you can buy back at this point and initiate new long position at this point. So the profit target would be very good in it, but the stop loss should be some feasible support and resistance for this system. Okay. There are some general popular combinations of moving average. What have the traders have back tested over a period of time, and they have generalized that some combination will work for traders is 9-day EMA with 21-day EMA for short-term trades. Right. This system works well on most of the stocks, but you have to verify it by backtesting that in reality it is working or not working. You can see it visually by analyzing the chart, by plotting the moving average on the chart and analyzing that how it is working or not working on that particular stock, because every stock has a different behavior. Okay, so it depends on which combination is working fine on which stock, and this combination can change with the change in market conditions too. When the market is changing its phase, like we are now in a consolidated bearish trend. Now the price is not falling in a very sharp momentum with a sharp strength. The price is falling like this. The price falls a little, then it goes into a consolidation point, then again it goes into consolidation. It gives some fake entries to trap buyers, and then it again falls, then it again started some consolidation. So this is a consolidated bearish trend. This type of trend shows you many bad entries. Okay, and you can use 25-day EMA with 50-day EMA to use medium term trades. On if you want to trade intraday, you can use 9-day and 21-day on a 5-minute time frame or 15-minute time frame for intraday trades. Okay, and if you want to trade for, let's say, a period of 3 to 6 days or a week, then you can use this moving average on hourly time frame, or you can use it on 2 hours time frame. Okay, the time frame will depend on your trading expectation. That you want to trade in intraday, then you should go for the 15-minute 5-minute time frame. And if you want to trade positionally, you want to trade swing, you want to do swing trading, then you can check out for go for 1 hour time frame. And if you want to trade positionally, then you can go for 1 day time frame. Okay, you can use higher time frame for identifying a trading opportunity. Let's say you are using 1 hour time frame, 1 hour time frame for identifying a trading pattern or a trading opportunity, but you are using 15-minute time frame to enter in this 1 hour time frame opportunity. You have identified the opportunity on 1 hour time frame, but you are entering the trade and exiting the trade by seeing the 15-minute time frame signals. Okay, for trades, to if you want some, and the third one is 50-day moving average with 100-day EMA. You can use this to identify trades that last up to few months if you are using it on a daily time frame. You have to use this period on a daily time frame. Moving average is very easy to use. There is no hard and fast rocket science in it. You just have to know that the behavior of the stock is working in line with the combination of moving averages I have selected, or I have to do some modification. Okay, you have to know it by yourself only. You cannot get this type of information in any. Okay, and you can use the 100-day EMA with 200-day EMA for identifying investment prospective trades on a daily time frame. Okay, or you can use that on a weekly time frame. So if you use 9-day EMA with 21-day EMA on a weekly time frame, then it will be a trade for a longer horizon, because time frame significance is that it will show you that at what is your time perspective. what is your time duration for which you want to take this trade. Okay. The properties of moving average. The first one is it is customizable according to the trader's preference. And how you can customize it is by using first the period of the period for the moving average. You can use it according to your need, and you can use that at what data point. Like there are some data points which we have discussed: the open price, high price, close price, and the LTP, last traded price. Okay, there are different type of prices. So out of these different type of prices, on what price you want that moving average to calculate an average price. There are some traders who prefer to uh, calculate the average price by using opening price of a session, but by default in the moving average indicator you will get closing price by default. You can change it to any other. Okay. And you can combine it according to your need, that you want to use. You are suitable in trading 10-day and 19-day period, then you can use this combination. It will be defined according to your trading style, your trading characteristics. Okay, and that's why the technical analysis is very subjective in nature. You have to identify by yourself. If I say that I will give you a setup that this 51-day and 100-day period moving average will work very fine, so that's how I this is a way of giving a very limited knowledge. But if I say that you can customize it according to your need, and you can analyze the market by using trial and error method. Okay, and once you find a good combination of moving average for a particular stock or indices, you can use it for a lifetime. Okay, you just have to identify for once that it is working or not. 1 year data for identification of a strategy is very good. Anything less than 1 year is might give you a false result. So if you want to know that this moving average is working well on this stock or not, then you should backtest that strategy for 1 year of data at least minimum. Okay. And it is similar that the higher the time frame, the higher the significance of moving average would be. Thus the moving average on 1 day time frame will be more significant than a moving average on 5 minute time frame with same combination. Okay, the combination for both of these time frames are same, but the significance is very much higher for the 1 day time frame rather than 5 minute time frame. And the rule which you have to remember for using moving average is it works well in only trending market. Okay. Do you have any doubt till now? We have completed the moving average topic. And for who doesn't know how to include a moving average, you can just click on indicators in any trading platform. If you are using Zerodha or investing.com or TradingView, doesn't matter. You can use indicators in moving average and you can just click on it. For EMA, you can write EMA. It will be available to you, moving average exponential. So you can see that let's change the color for simple moving average would be of red color for 9-day period, you can see here. And the EMA for the 9-day period, the both the moving average are for same period, but the blue color, the exponential moving average, is reacting uh, very fast to the price. They have a little discrepancy. This is the difference between a moving average and a EMA. The EMA reacts to the price very fastly than the simple moving average. Okay, so you have to know that which moving average is working well on this chart. So if you can modify the inputs by using the length, you can increase it by whatever period you want. Okay, so we want to see that at what period of moving average the price is taking support. Still not close to it. So for the 81 period moving average, I think that is working very good for a 1 hour time frame, that it is taking exact support points. Okay, it is taking supports at the exact points on this moving average. So that's how you can see that which time frame, on which time frame, at what period of moving average is working well. So we have identified 1 hour time frame, we have used 1 hour time frame, and we have identified some, that out of many of the supports, it is reacting very good. You can go on and check the past data. Okay, when price is moving in trend, it is reacting to this moving average or not. Or if you want to modify, you can change the input in it. All right. Okay, so we will discuss our next topic of RSI index and MACD index in the next session. If you have any doubt till now what we have learned, you can ask me, and I will share this PPT till now, what we have learned till moving average. After this class, you can go and practice some of the support resistance and all of the moving average, and identify some stock that are working good for a certain combination. Right.